Welcome, everybody. This is Christine Kopr, Senior VP of Sales with Sotheby's Realty in Vancouver, BC. And today we are speaking with Jacqueline Zerbe from Total Mortgage in North Vancouver and talking about this morning's rate announcement. Woohoo!
Woohoo, indeed. Thanks for having me, Christine.
Thanks for joining me today, Jackie. It's always a pleasure. So give me the scoop. What happened last night for those of us who haven't seen the news yet?
Yeah, exciting stuff. Thankfully, the Bank of Canada lowered their overnight rate target this morning by a quarter point. So they're sitting at 4.5%. So we'll see the prime interest rate follow suit. That should decrease from 6.95 down to 6.7%. So that's fantastic news for anybody that has a variable rate mortgage or a line of credit because your payments will be decreasing very soon.
In terms of someone with a variable line of credit or variable mortgage payment, that would be one where their payments are adjusting according to the interest rate, right?
Yes.
So,
So with variable rate mortgages, there's two kinds. There's an adjustable rate mortgage, which means your payment will fluctuate as prime fluctuates. So as prime increases, your payment will increase, and as prime decreases, your payment will decrease. With a static variable rate mortgage, your payment will stay the same. But as prime changes, the proportion of how much of your payment goes towards principal versus interest will change. So depending on where you're at in your static variable rate term cycle, you can potentially phone your lender and ask for them to decrease your payment manually, but it all depends on if you're staying up to date paying your mortgage as per the agreed amortization that you signed up with originally.
got it. Okay. So that's a good tip. So for those that are on a variable, but maybe don't have the payment changing with every single rate decrease, a phone to your broker, your lender can help you change that to reduce your payment so that you're saving a little bit of money every month, because as we all know, things are definitely changing, and why we've had another interest rate decrease. Do you want to touch on that just a little bit? Bank of Canada's decisions on why they decided to
Sure.
decrease
Yeah.
the interest
Yeah,
rate?
so exactly. So thankfully, inflation has been behaving itself over the last few months, and it has been steadily decreasing. So they're keeping a close eye on inflation, and they expect inflation to continue to decrease over the coming months. That's a big driver for them lowering their overnight rate. The biggest bucket of inflation is still that shelter cost, which is your mortgage and your rents. So that's still pretty big proportion of keeping the inflation high. But as that comes down, we'll see inflation continue to come down, which is great. In terms of the overnight rate, when the prime rate does drop by a quarter point, that's going to be about $15 less per month for every $100,000 that you're borrowing. So that's going to definitely help Canadians' pocketbooks for sure.
Right. So that's $150 for $1 million mortgage, if I'm not mistaken.
Exactly. Yeah, correct.
On this rate decrease, obviously, we've had one prior to that. So if you have $1 million mortgage, that's a $300 a month
Yeah.
payment increase between both reductions. Okay, awesome. And obviously, I'm not sure if you're getting the phone calls, but I've certainly have started to hear here and there some people being impacted in the economy, recession-wise. Are you getting any phone calls from people who are, potentially have lost their jobs or anything like that so far, or not so much, and
I
maybe
I
managing?
haven't no, I haven't heard from clients that have lost their jobs. Continuously for the last couple of years, I've been getting phone calls saying, we're really feeling stretched and we're finding it harder and harder to make our mortgage payments each month. So there's a lot of refinancing that's happening in order to improve clients' cash flow. And with these lower rates, we're able to do that, and also by extending the amortization. So for sure, that's helping. A bigger topic of discussion that's starting to happen now is whether or not clients should go fixed or variable, because obviously as prime decreases, it's becoming more and more attractive to consider a variable rate mortgage. There's still quite a big gap between fixed and variable rates though. So you're still about a 1 percentage point lower if you're choosing a fixed rate versus a variable rate. So it does come down to personal preference and what your long-term goals are for sure.
Right. So what you're saying is currently, if you're thinking, okay, I've got my mortgage renewing and I need to decide if I'm going to renew into a variable or into a fixed rate. Variables are up here, fixed rates are down here. So if you wanted to capitalize on the decreasing potential future decreases, you would have to actually have the Bank of Canada reduce interest rates by a whole percent. So like 4 quarter point reductions just to make it to where the fixed rates are sitting today. Is that correct?
Exactly. Right
Oh,
on the money. Exactly. Which for some people, they're fine to take that choice and wait it out, wait for prime to come down. But for others, they're feeling so stretched that they just want to have that lower interest rate right now and have that stability and peace of mind, knowing exactly what their payments are going to be without worrying when the next Bank of Canada meeting is and what they're going to decide at that next meeting. So,
right.
yeah,
Yeah, being able to sleep at night and having peace of mind is
exactly.
important, right? Especially so you can focus on other things. Okay, so very interesting. And it sounds like you're able to help people. Like interesting to hear because obviously we've had this like massive run up in interest rates over the last few years, peaking just not too long ago. Yeah, maybe you can just share a little bit more about that. Like, what are the chances that if somebody called you today feeling a little bit stretched with their current financing that there's a chance you might be able to help?
Absolutely. I actually just had that call a couple weeks ago where clients of mine were feeling really stretched. They've racked up their credit cards because, as you know, everything is expensive, groceries, gas, everything. And they were feeling super stressed because they thought they might have to do a consumer proposal. And luckily, we were able to help them out because they had equity in their home. We were able to roll in some of that short-term debt into their mortgage without even touching their existing mortgage, which is at a super low rate. So we were able to consolidate that high interest debt and really eliminate that stress off their shoulders. So there's definitely options available for clients. And there's more than 50% of mortgages that are coming up for renewal in the next 2 years. So it's really important to get that conversation started early so that we can start to monitor interest rates for you and explore different options for you so that you've got lots of time. You can really take in all the knowledge and let it sink in, and then you can make an informed decision that works for you and your family, because the last thing you want to do is leave things to the last minute and then you're feeling rushed and pressured and you're under the gun and you feel like you haven't really done your due diligence.
Right, and make that decision so quickly. Okay, so in summary, it's a good idea to reach out to you because, and yes, it's true. Just seeing some of the numbers out there, about 50% more of the mortgages are still needing to renew into this new higher interest rate environment. I was just looking at my monthly stats that I do every month. I track when the rates go up and go down. So in July, we had a reduction. May, June, we had a reduction. But prior to that, that would put us back to, well, the last two increases were June and July of 2023. So interesting that interest rates are going back to where they were about a year ago. And what has the market done since then? Well, not a ton. I mean, the fall was not that great. The spring had some early activity, and here we are today. So interesting that we're getting back to where we were. But what's interesting about last summer is right prior to that, we had a very active market. So, what are the possibilities that perhaps after a couple of more rate decreases, we might see more favorable market conditions? Anyhow, I digress because we are seeing a lot of people rolling into this higher interest rate environment. Myself, even I know got mortgages that will be coming up, not next year type of thing. And I know that I've got clients that are seeing renewals coming up all the time. So um yeah, interesting. Even with these rate decreases, I still think that based on where people were, because so much, when people are calling you, was the financing probably secured around that 2% rate?
Yeah, I have a lot of clients in the 1.5 to 2.5% rate, and a lot of them are stressed out, scared to be renewing into something that's double. Um,
Right.
so there's a lot of explanation happening and a lot of different scenarios being worked on so that things aren't as bad as they initially appear. So I think clients don't necessarily realize that there's lots of options available. I do think having those super low rates is a thing of the past, unfortunately. I think we're very spoiled in that the last 15 years we've had extremely low interest rates. That's not normal. In my opinion, rates in the 3.5 to 4.5%, even 5.5% are normal. So I think the more people that wrap their heads around that and begin to realize that that's the norm, then the shock will dissipate.
Right, the new normal.
Yeah.
So, okay, so having said that, if clients are coming in at like 1.5, 2%, that's where they're coming from. I mean, obviously I know this varies whether you're like conventional, unconventional, insured, uninsured mortgages. What's the range of what rates are, what you're seeing today?
So for fixed rates, you're seeing anywhere from 4.5 to 5%. And for variable, you're going to be seeing anywhere from the high fives to the low sixes. Um, and obviously that'll come down as prime continues to come down. But more important than the interest rate is focusing on what the monthly payments are, because that is really what impacts Canadians' pocketbooks. So our job is really to guide clients through the options that are available to them. Obviously, we look at all the different products available, as well as different scenarios in which we can improve your cash flow, either by extending your amortization or doing some debt consolidation, because a lot of people are carrying extra debt, whether it's on lines of credit or credit cards or car loans, student loans. So that's our job, is to help really take a holistic approach and look at your overall well-being. So yeah, that's what we're here for.
Awesome. So it sounds like there's lots of options that the consumer can reach out to you for and figure out, they may not even be thinking about it. Maybe things are okay for them right now and they can kind of like muddle through this, but perhaps haven't even considered that there might be ways, whether they have car loans or, like you said, credit cards, student debt, whatever the case may be, you might be able to help them find a product that has better rates and better payments so that they can make their expenses more manageable. So that's
Absolutely.
cool. I have one last question before we move on to the topic of with the new regulations regarding the rentals, the new rental regulation. I've spoken to a few clients here and there who I know have actually, as the rates were going up, maybe have decided to lock in into, some shorter term product, perhaps. Wondering if it's even possible to comment on like, if somebody locked in the last year or two, like maybe what rate they may have locked into in maybe a 3-year term. And when that comes up, if things kind of like are where they are today, would their payments be the lower, the same, higher? Just kind of curious about that. If
Mhm.
there's anything you could share.
Yeah. So, 6 months or a year ago, many clients were choosing for a shorter fixed rate term, like a 3-year, for example. And that was sitting at about 6.25 or high fives. And right now, that 3-year rate is down to 5%, give or take. So there's definitely opportunities to be saving money. Those clients that took a fixed rate a year ago, absolutely, we can look at refinancing. We'll crunch the numbers to see what the penalty is and how long it would take you to recoup that penalty. My opinion is that a shorter fixed rate term is quite attractive versus the 5-year fixed rate, because I'm of the mindset that hopefully interest rates will continue to come down. But it's definitely a case by case basis, looking at clients' individual needs. So for sure, it really just depends on what works for the client in terms of cash flow, what their plans are for the next few years. It's not simply a question of, okay, well, what's your best rate? We really do take that holistic approach to ask the questions like, do you foresee yourself moving in the next few years? Or do you think you might want to tap into equity for home renovations or debt consolidation, or possibly to buy a vacation home or an investment property? So there's a lot of future planning involved when we're having those mortgage renewal conversations or the refinance conversations, for sure.
Right. And that's because like one of the things is if you sign up for a 3-year term, if all of a sudden 3 months later you're going to be selling because you're moving somewhere for a different job or whatever the case may be, there's a penalty associated with a fixed, right? And then
Exactly.
all of a sudden it kind of negates all of that. And there's this other cost that you didn't consider. So refinance is like with the stress test and the hurdle rate. And, one of the conversations out there was that people can't really refinance these days because they may not be able to qualify for the mortgages that they have today. Is that something that is like actually happening? Are there lenders out there that are kind of seeing, like, because I heard that there are some lenders who just like don't care and are looking past the stress test. And if you have your mortgage, they'll allow you to refinance. I don't know if that's rumor or
Mhm.
certain lenders or product. What can you share about that?
I haven't seen I haven't heard of lenders looking past the stress test when it comes to refinancing. When it comes to renewing and switching, if you had an insured mortgage where your down payment was less than 20%, when you come up for renewal, you can switch to another lender and you don't have to qualify at the 2% stress test rate. You can qualify at the contract rate. So that's very attractive if your current lender does not have competitive rates at renewal. We could move you to a different lender that has competitive rates and you don't have to do that stress test if your original mortgage was insured. If you're looking to refinance, absolutely, you will need to qualify under the stress test. Some lenders have a lower stress test, but it's case by case and there's certain qualifying parameters. So if you're curious, you can reach out. Again, our job is to monitor the market for you, look at all of the different products and give you some options to explore for sure.
Right. And that's one of the differences of working with a mortgage broker, right? Because if clients go to the bank, they go, oh, I bank with TD or I bank with Scotia or I bank with whomever. That lender can only offer their one product, and they all have different, while so many things are the same, regulations, their parameters can differ. Whereas somebody like you, licensed mortgage broker, can speak to various lenders and see if there's other opportunities or product out there.
Exactly.
Cool. Okay, so let's move over to the new rental legislation, effectively increasing the notice that needs to be given to tenants, increasing from a 2 months notice to a 4 months notice. And people might be wondering, well, why does that matter to me? I'm going to be buying my new home. I'm not a landlord. I don't care. However, it does matter if you're thinking about buying a tenanted property. There's definitely some impacts on buyers today. So, Jackie, can you tell us normally how long does a lender hold your rate for?
Usually lenders are able to secure rates and hold on to them for clients for 4 months, 120 days. So prior to this new legislation coming in, if you had to provide an eviction notice to a tenant to vacate the property so that you could then occupy the property, you would have to give that eviction notice with 2 months notice, which is fine. Now you're giving a notice for 4 months. So it might not quite align with your rate hold, which could prove to be tricky because you might be approved for a mortgage with a particular rate, and you might only give the tenants notice to vacate a week or two after you actually
Secured that.
complete that purchase. Yeah. So, there's a little bit of a gray area. So it remains to be seen because this legislation was only introduced on July 18th, but it's definitely going to make some qualifications a little bit trickier. The good news, though, is that we're in a decreasing interest rate environment. So if the tables were turned and rates were starting to increase, this might be a bit of a sticky point because now suddenly that rate hold that you might have had, that pre-approval that you might have had, you might no longer have that rate because now you're outside of that 4 month window. So we'll see how things progress. I'm hopeful that lenders will work with clients when it comes to properties where you do have to vacate the tenancy, but we'll see.
Right. Okay. And just to help explain or clarify for people, if you're out there buying a property and you find the right one and you write an offer, you're going to write an offer and you're probably going to have some subjects, and subjects are typically 1 to 2 weeks. So there's like a gap in there in terms of, your due diligence period. And you should have already spoken to your mortgage broker. You should already have a pre-approval. You should already be qualified, right? And so then you work 2 weeks in, and then you go through the subject period and everything is great. You decide to move forward with the property. So you waive your subjects, which is when you commit to purchasing the property contractually. But that's when the notice is served to the tenant. And for example, if after your subject period lands at the beginning of a month, so let's say we were out shopping today and we found the right property for you, but you didn't waive your subjects till early August, let's say like August 8th, the notice that will be served to the tenant will be served in August, but it's only effective at the end of August. So what is it, 31 days in August or 30? Can't remember. But it will be effective the end of August. And now that 4 month timeline begins. So you go September, October, November, end of December, and the first day you can occupy the property without having a tenancy intact is January 1st. So now we've gone through August, September, October, November. and now you're into January, 5 months. And if anything went weird in there, that process could go a little bit longer. So you're well out of your 120 days. And, I was under the impression lots of lenders are only 90-day rate holds as well. Is that true? Like
There's most lenders are 120. There's a handful that are 90. Most of the lenders that I work are 120, thankfully. So yeah, always good to check if you're not working with a broker and you're working with somebody that only has a 90-day window, you might want to back yourself up and get a 120.
So, and that's another challenge, or I've heard, because the thing is that lenders approve buyers and they have a certain amount of approval time. That's a lot of time to go past from the time that you actually waive subjects to actually completing. Like even for myself, for my clients, I recommend not even completing on January 1st because the tenant has to be out at noon, December 31st. Then the landlord still has to deal with, well, what if there's any damage from the tenants and they need to deal with the issues regarding the security deposit? You don't know. So then you need to find contractors if there is issues. You don't know what their schedule is like. And so having actually at least a few days to deal with any hiccups, now you're being pushed into a few more days into January. How is this going to affect buyers? So the whole premise here, or at least our government is saying we need more housing, we need to get people into their homes, and buyers are going to be trying to buy properties, and often for like getting into properties, first-time home buyers are really the people that we can't, that we're trying to get into the property ladder, probably going to be focusing on those, 1-bedroom, 2-bedroom condos, the entry-level stuff, which tends to be tenanted property. Are lenders going to keep their approval alive? Like I've heard that there are risks that buyers will have waived their subjects and then the approval to buy that property will die, or lenders won't even look at it because it's too far out. So not even the rate hold issue, but dealing with having the approval that doesn't disappear on you during that time before you can actually complete on the property. What are your comments on that?
I've seen lenders approve a file and in the mortgage commitment, they specifically state the interest rate will be confirmed once you're within 120 days of completion. So you might have an offer where it's 5.5 months from now. The client needs to understand that the interest rate isn't set until 4 months prior. So yeah, they are approved based on whatever the lender decides is the qualifying rate at that point, because the lender can't, it's a moving target. So clients need to know that there's a bit of risk for them because they don't actually know what rate they're approved at until that 120-day mark, which is tricky.
And besides the rate though, can their approval expire? Like, can the bank all of a sudden say you're not approved? Or perhaps the risk is, well, what if interest rates go up during that time and suddenly you don't qualify at the new rate? Like that, perhaps that is the risk that we're talking about.
Yeah, that's the risk. I haven't seen a lender pull an approval because of a long completion date. I think the risk is we don't know where interest rates will be in the future, and the client is taking on that risk. So we'll see. I'm not sure what the lender's policies will be, if they'll change or not. I think sometimes the government tries to help, but they roll out some initiatives that aren't necessarily the best thought out, and then they deal with the repercussions after. So it remains to be seen how this will all unfold.
Oh yeah, the unintended consequences of rolling out policy without getting any industry feedback. I have lots of my own thoughts about this.
Yes, that's a topic for
a whole
another
other
day.
can of worms. We'll have a IG live on that one day. Okay, great. Well, I think it's an interesting thing, right? Like buyers do need to be aware about that, and that risk factor then can also be turned into an opportunity, because I think we're going to see some more negotiations for buyers if they are buying tenanted properties, and for sellers that have tenanted properties, they need to be prepared that this could be a real issue or can affect the value of their sale, because buyers are going to want to be compensated for this additional risk, which means the opportunity for buyers is you might be able to negotiate a better deal depending on your risk appetite or your own scenario, which only you know. And after discussing with a mortgage professional like yourself to understand what that could look like. So you might be able to take advantage of this situation. Obviously, there might be some other buyers who may not, and they might be not comfortable. They might not be in a position to, have that risk hanging out there. And that's going to be shutting them out from the market unless we can come up with other strategies. And for sellers, there are definitely some different tactics that can be taken, because obviously having a tenanted property is going to affect their sale. And we do have some strategies on how to deal with that. So that's another topic to be discussed. So I think we've kind of covered most of everything today. Any other closing thoughts or, interesting perspectives for like that you may have, or maybe interest rate predictions?
Oh, yeah. What do you think is going to happen?
Well, I was wrong the first time around. I didn't think that the Bank of Canada was going to reduce interest rates when they did. Last night, actually, I was lying there in bed going, oh, what are they going to do? But just starting to see the data, like as you mentioned, the core piece of inflation is interest rates. So like as long as we have high interest rates, we're going to have a big, that's going to impact the inflation rate. As rates come down, that is going to help reduce that. So that's going to keep inflation in that part of inflation in check for the Bank of Canada. I think that that there's a lot of pressure on the economy that we're not seeing quite yet. But new construction is basically at a standstill, and so there's a lot of good jobs out there in the construction industry. And as projects wrap up, there's going to be people coming off of those projects, and they're not going to have projects to be moving into. And I think as that, lots of businesses book their business in advance, and as projects wrap up, whether it's in construction or anything else, when those roll over in the near term future here, there's not going to be something to roll into. And I think that's when we're going to start to see the pressure on people. And I think that's starting to happen, not just people, a culmination of people maybe rolling into interest rates that are higher, but the impact on the economy, especially in the tech space, because, Vancouver is very much a tech based city now, besides resource and other types of industries. So I have a feeling we are going to see some more interest rate decreases. And I've heard that we might see 2 more before the end of this year. I think that, one of the challenges we also have is the US. Like if the US starts to reduce their interest rates, then I think that there'll be a more level playing field for that, because we can also experience inflation if the US doesn't decrease and we do, because then our dollar is weaker and then everything that we buy in US dollars is that much more expensive. So what are my predictions? I think I'm going to roll with, I'm going to put myself out there. Perhaps we'll see. How many more meetings are there?
There's 3, I believe.
3. Well, perhaps we'll see 2 more interest rate decreases of a quarter point. I mean, it'd be great if they chopped it off at like a half a point, just made the big splash, and then we'd be down like 1 whole percentage point. But I don't think that's going to happen. But I'm going to put myself out there and, and actually cross my fingers that we have lowered interest rates. Although I hope it's not because of the pain that can be coming in the economy, and that's the double-edged sword of this. But I'm going to vote for 2 more quarter point decreases.
Wow. Okay, good. We shall see.
I don't know. What about you?
I think there will be at least 1 more quarter point.
Yeah.
Hopefully there'll be 2, but it's really hard to know, right? I think there's a lot of uncertainty happening in the States with the election coming up, and I think that's really going to impact interest rates in the fall. So it should be interesting to see what unfolds.
Well, I was wrong last time I put myself out there, so we'll see. Usually I'm a little bit more conservative, but I'm trying to be a little bit more bullish, but in the sense that, like, as I read more of what's happening, like from the economic standpoint, I think that we could get into some real trouble here in our economy if we don't see decreasing interest rates. But like I still know that there's a fear of inflation, like it's legitimately still out there, because as you said, you still feel it in food prices and all that, and none of that's going down. Like I just think that people also need to realize, like, we'll never see lower prices again. Like that's what they are. It's the rate that they continue to rise that we're hoping is lowered. So like, this is our new reality. This is what happens when you print money and just send it out into the world. Assets inflate and yeah, you debase our currency. So here we are. We'll see
Here
what
we are.
happens. Well, thanks so much for your time, Jackie. I really appreciate it. And I look forward to doing this again. If you can think of another topic that you want to discuss, I'd be more than happy to do that next time.
Fantastic. Thank you for having me. Always a pleasure.
Wonderful. Have a great one. And make sure you reach out to Jackie with any of your questions. If you're thinking about renewing or wondering about some debt consolidation, thinking about buying or selling, I'm here to discuss, especially if you're a owner of a tenanted property. I'm Christine Kopr. See you next time.